Hi, everyone. This is Jason Bjerk of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a returning guest. He's won the Dow and Founders Award 5 times. He has two exchange-traded funds, the Risk On and Risk Off ETF, RORO, the Junk On and Junk Off ETF, JOJO. He also manages a mutual fund, and he's the publisher of the Lead Lag Report. And I believe he's interviewed over 1,000 experts now for his podcast and his Twitter Spaces or X Spaces. Michael Gaid, Chartered Financial Analyst. Thank you for joining me again.
And you're among those experts. I had you on one of my shows, I want to say a year ago, was it?
It was a little over a year ago. I think it was January 2023, and I was talking about uranium, and I was getting a lot of hate for it.
And you were spot on.
I was. That was one of my good calls. Now, I was wrong on the gold stocks, but actually, like on a cash flow multiple, some of these gold stocks are literally minting money. There's a huge dislocation. We can maybe talk about this later in the interview. There's a huge dislocation between the gold price and the gold stocks right now.
Yeah, and actually, I put a piece out on the Lead Lag Report, making the case that miners are kind of the quintessential value trade. But before we get too deep into things, I think people forget it's okay to get things right and wrong, because that's the way this business works. I find so many people try to do these gotchas. Oh, you got this call wrong. You got this thing incorrect. It's like, yeah, I mean, the best traders, investors in the world maybe get, 35-40% of their trades right, of their big picture ideas right, and the rest wrong. But when they're right with magnitude. I mean, that's incredibly true when it comes to uranium. Who cares if you got other things wrong? You killed it on that end.
This is true. Uranium was one of the top performers in 2023, along with artificial intelligence stocks. Before we talk about maybe index fund and artificial intelligence and the potentially a tech bubble that's happening now, get your thoughts on this credit event that you've been predicting for a while. Do you think that the probability it happens in March or April is very high, and why?
I mean, I wish I could tell you in June if that's the case. But okay, let's take a step back. So just because I think a lot of people misinterpret words that I think are very clear, but at the start of last year, I said in 2023 in January that it would be a melt-up year, but that towards the end of 2023, there was the risk of a credit event. And the thinking was very simple. You have the lagged effects of the fastest rate hike cycle in history combined with the sudden realization that you have this debt refinancing tsunami that's coming, because a lot of corporations issued or rather borrowed at very low rates post-COVID, and a lot of those loans mature, right around now in a 3 to 4 year time period. Now, entering November, I was very, very bearish. I was, looking at various intermarket dynamics. I thought, this could be it. I could be right that it happens right around now. People forget that small caps, the Russell 2000 broke the October 22 lows. You look at micro caps, it was even worse. The Dow was negative in a pre-election year up until that point. And then you had the stick saved by the Fed. Market starts thinking 6 cuts are coming, massive rally. And there goes the credit event thesis towards the end of the year. I get egg on my face. Everyone hates on me, right? Now, the thing is, we're still in that lagged window. You're still in that time period where something can very suddenly break. Now, I've been flagging on X at Lead Lag Report that I think March could be a higher risk month. Not necessarily because I think a credit event happens there, but you never know, because Japan might start to take some actions on their own rates, which might have global implications. But either way, I don't think the risk has fully gone away just yet. And the reason I say that is when you look at small caps in the US, small cap stocks are the most vulnerable to credit. They're highly levered. They've got razor thin margins. Small caps have gone nowhere really in over a year. And the only reasonable explanation for that is, because they're worried about the cost of capital. Some of these companies may not make it, may not survive. So my point is that, as much as I was wrong on the timing towards the end of last year of the risk being there, I think it was there, just the outcome wasn't. At some point, people have to ask themselves, why is it that small caps are still not working? Why is it that the areas which are most sensitive to an expansion to liquidity are not acting like it's a bull market? And the simplest answer is the right one. There probably is some real concern that, there is some kind of credit event out there.
There's also a lot of macro cross currents. You have a lot of flight capital out of China. The Chinese stock market is not doing well. The Chinese real estate market is not doing well. There was an interview in Financial Times a couple weeks ago that Chinese fund managers, Chinese retail investors, they have lost faith in Chinese stocks and Chinese real estate. So that capital is going to leave. I think that's one of the reasons why we're seeing Bitcoin prices up and also US tech stocks. And then you sent me an article a week or so ago about a fund survey, a survey from fund managers that the number one event they're actually worried about is commercial real estate and credit tightening from the banks.
Yeah, and I guess this is sort of the why this is such a deceptive environment. I've said this is like it's a concentration bubble. It's not a tech bubble. I'd argue for a lot of different reasons. It's a concentration bubble, meaning you've got some parts of the risk-on marketplace which are saying everything's fine, and then you've got the majority of everything else being concerned about commercial real estate, being concerned about regional banks, being concerned about the state of the consumer. And it's not clear which is right and which is wrong. Meaning it could very well be that, because everyone knows about commercial real estate and everyone's worried about it, you shouldn't be worried about it because it's being discounted. There's also an argument to be made that, yeah, you can worry about it, but until the headline averages start to worry about it, it doesn't matter. And when the headline averages start to worry about it, that's when it really gets to be scary. The point is that it's not clear at all, in my view, how this ends up shaping up. I get it. Most people are indexed to the S&P. Most people have made money in this environment, and a lot of people have killed it when it comes to some of these high-flying momentum trades like in Nvidia and other AI names. But you have to at least question how long these divergences, how long these disconnects, how long the inconsistent narratives can last. Because history has shown that when these narratives end up getting righted, it tends to occur very viciously and violently. And all those people that made a ton of money suddenly give it all back.
Yeah, it kind of reminds me with the macro factor, similar to studying a year before the October 1929 crash. There's a lot of macro factors here saying there shouldn't be a stock market bull market in these stocks, but there's also a lot of flight capital. So you have all these distortions in the macro factors, and then a tech bubble or a small concentrated bubble of a handful of artificial intelligence stocks. It's not even the Mag 7 anymore. It's only a couple.
Yeah, and I think also people forget that, like some people will come back and say, well, what about financials? They're 2 years highs. What about industrials? They're at highs. Yeah, partially you can argue that that's to be expected because there's this kind of feedback loop, right? So to the extent that the Microsofts and Nvidias of the world are driving the S&P 500, that momentum then drives all the stocks within that, even though it's disproportionate against the top, 3 or 4 names, right? The broader issue, which again, I don't know why people are unable to just kind of think through it carefully. The broader issue is, show me a bull market where you had this much of a divergence in a concentrated number of stocks against everything else. It can't be healthy in a society to see a widening wealth gap in the same way that it can't be healthy for the stock market to have a widening market cap gap. At some point, that's going to break. I don't know when. Obviously, I was wrong on my timing towards the end of the year. Now, keep in mind, I could be right. That doesn't mean that you short. It's like, this is one of my big pet peeves. It drives me absolutely crazy because I say it repeatedly. You can have a thesis. In my case, the thesis is there's a risk of a credit event. That doesn't mean that you short the stock market. That doesn't mean you necessarily go into cash, because you can be bearish and long. How are you bearish on stocks and long an asset? It's easy. You long treasuries, you long gold, you long the dollar relative to other currencies, right? Certain ETFs that do that. You long the defensive sectors, utilities, staples, and healthcare. That way, in the event that your thesis, or my thesis in this case, around a credit event is wrong, you still have a chance of making money. I mean, I actually think it's the height of having an ego if anybody thinks they can short and time things perfectly. Humility says that the best way to play, to be bearish, is to recognize you may be wrong on your bearishness, which is why you don't want to make a pure directional bet.
The last 10 or 15 years, a lot of shorting hasn't really worked anyway, especially with central bank balance sheet expansion, quantitative easing programs, zero interest rate policies. Back in November, we had Jim Chanos' short fund. It got down to, I think, 300 million assets under management, and he decided to shut it down. Also in 2023, we had Christopher Cole, who I think is one of the smartest guys in finance, Artemis Vol, his volatility fund. That fund shut down. I think in mid 2023, it was gone. So there are signs here that like what used to work in the past is not really working. Do you agree with what David Einhorn has said recently? He did a long interview on Bloomberg on a podcast in the last couple of weeks. And he basically said that the index funds, passive investing has broken a lot of the past, a lot of what used to work in the past with markets and value investing. Do you think that that much the fund flows with retirement accounts and index fund investing has broken markets or changed it drastically?
So a few things there. First of all, you probably also saw those headlines around, I think Bloomberg had a piece on it, how these tail risk funds are also blowing up and are not going to survive. The more I see stories like that, the more it makes me think that we're probably due for, some kind of meaningful volatility and tail event, because all these things which are supposed to benefit off of those types of dynamics are no longer able to even survive, right? So it's like if you have fewer players betting on the outcome, then you can almost guarantee, and that's a very difficult word in our industry, that that outcome is going to come sooner than later. But back to your question, I do think it is true that we are no longer in an environment where there's true price discovery. And I say that because true price discovery assumes active management, assumes that there are people actually looking at balance sheets, actually allocating based on capital and risk and return potential. And when you're in a world where you have these auto bids, primarily on the 401k side, people's paychecks going into Vanguard market cap weighted type of funds, that it does create distortions, that the S&P 500 no longer becomes a reflection of the future. It's rather a reflection of the present because it's based on those default buys, right? And that is such an overwhelming force. Now, I don't know if one can say that that's a permanent dynamic. And the reason I'm saying that is, first of all, it sounds like this time is different. So you want to be careful in general with that kind of thinking. But it's actually very easy to I'd argue, restore price discovery. You restore fear. And in order to restore fear, to cause people to sell and to stop the rate of inflows into passive market cap weighted type of funds, you need a recession. You need unemployment to rise. You need people to have to dip into their 401ks to pay for milk. I mean, like in a very kind of basic core level, because they no longer have a paycheck. So I think what's happened is, yes, there's a lot of distortion, and I do think there's a lot of it's not a healthy environment because you don't have real fundamental players like you used to. Everything is just about index passive investing. Even Bogle himself had alluded to the idea that passive got too extreme prior to his passing. That doesn't mean, though, that you just give in and that you just go into the S&P, I think.
Well, also, we should caution people that just because there is all this money going into index funds, and I think some of these index funds, they own 50% of the shares outstanding of some of these large cap companies. It's nuts. I don't think they were ever intended to own over 40 or 50% of some of the shares. But just because there's all this index fund money doesn't mean there can't be a crash, like a quick event, maybe a V. But unfortunately, we have a lot of policymakers, central banks, governments, regulators, and politicians and bureaucrats. They do not want to allow deflation, debt deflation, bankruptcy, asset price deflation, prices falling for a long period of time. So every time there is a crash, if there is one, they seem to want to just change the rules, move the goalposts, and then just create a new liquidity program so they don't allow market forces price discovery for very long, maybe a couple of months at most at this point, post 2008.
Isn't it funny? I mean, I know this sounds controversial, but I don't see how it is. It's like bizarro world. It's like China's market is more of a free market than ours.
Well,
I mean, they're letting their market free fall.
Well, aren't they they're trying to ban short selling, but it's not working. I mean, they are trying to pull these levers, these Keynesian levers, but it's not working.
Yeah, but not to the extent of like what the Fed has done. Right now, maybe they will. Right, I mean, maybe they'll go the way of Japan, right, with buying up ETFs, right, and to prop up their markets. But my point is that there is no free market. It's like everyone loves capitalism until there's losses. Everyone loves the idea of making money in equities until you realize there's a risk of losing money. and then you want big daddy government to bail you out. Again, I go back to none of this is ultimately healthy in the long term. It creates distortions in society, creates distortions in signaling. I mean, consider this, right? So to the extent that these AI companies are becoming a larger, or Nvidia and Microsoft are becoming larger and larger portions of the indices, and then the indices have a crash. So what's the implication there? What the Fed then is not bailing out the stock market or the economy; they're bailing out Microsoft and Nvidia because those are the companies driving the indices. I mean, think about how insane the setup is if this type of concentration dynamic continues. How is that anything that anybody should cheer for?
And they're not creating a lot of jobs. Those companies are not creating jobs. I mean, like in the headlines, a lot of those companies, big tech, the larger banks, they're the ones firing people now. And it looks like they're trying to replace them. They're trying to fire a lot of these middle managers earning over 100,000 with artificial intelligence or outsourcing.
Yeah, it's like I was joking with a financial advisor I was talking about to earlier. It's like, you want to hedge losing your job, you probably have to buy Nvidia. I mean, that's like the weird environment that we're in. Now, by the way, I am legitimately skeptical around a lot of the narratives around AI because I think a lot of this stuff is just becoming marketing. I mean, you look at any company now, and they mention AI. Oh, we're using AI to do this and to do that, and it's like, no, you're not. You're just doing the same type of large data regression analysis you were doing beforehand, but your marketing department said call it AI. So, like, I do think we're in this narrative bubble, right, which is creating a concentration bubble, which is why we have such disconnects internally in the marketplace.
Yeah, I agree. And also,
it'll end. It'll end. It has to. It'll end at some point.
Well, I also started researching that if some of these artificial intelligence investments do come to fruition the next like 6 to 10 years, the amount of electricity that's going to be required, and some of the estimates potentially are suggesting that the global electricity demand usage could potentially double with the amount of data centers. So no one's talking about this yet. No one's figured this out, that if they start building all these additional data centers, because the average person just sees, oh, it's ChatGPT, oh, it's a software program, oh, it requires no humans, no energy, no nothing. It's just a software program. They don't understand all the big data and the data centers that are needed for all these types of investments. There's a ton of data centers being built in the United States, specifically here in Northern Virginia, where I am. I think about 20% of the annual power usage in the state of Virginia now is solely from data centers.
That sounds like another reason to be bullish on uranium. I mean, I think that's kind of the. No, I'm sincere when I say it, but I've written about that for Investor Place. Also, you're exactly right. Nobody's talking about this stuff. Look, this moment reminds me very much of, I forget the exact year, but whenever Musk basically was, I think it was 2016 or 2017, basically saying that by 2020 we're going to have fully autonomous cars. The problem with all these narratives is that you get pretty close, but that last mile is the hardest mile, and the valuation, the real increase in value comes from that last mile, that last bit of creating the perfect processor system, and it's always elusive, right? So, and to the extent that markets are not are pricing that in now, but then, by the way, seemingly not pricing it into utility companies, maybe because they're realizing that last mile is going to prevent that electricity usage from ever getting to those numbers in the most optimistic scenario, tells you that we're this is a story. It's a story. I mean, I'm not disputing that Nvidia has tremendous growth, but if that growth only is benefiting one company and nobody else, and then nobody's thinking about the ads, like people are gonna all these buyers of these GPUs, they're gonna have this and they're not gonna know what to do with it in a year. So what's gonna happen to demand?
Yeah, I see a lot of distortions and red flags. I also see a ton of insider selling, which is rare considering like the narrative in the financial media is bull market, artificial intelligence, new bull market. The real economy is doing well. Here you see net insider selling from Jamie Dimon, CEO, JP Morgan, Mark Zuckerberg, Jeff Bezos, Bill Gates. There's a lot of net insider selling. This is really rare. You're not seeing net insider buying.
Yeah, I mean, listen, you and right, and you also have Zuckerberg and others building these huge bunker towns underneath the ground, right? I mean, at the same time, honestly, if I were that wealthy and was tied up in stock, I'd probably do the same thing, just because you got to live a little, and you can definitely live a little bit when you have $4 billion in cash. But I think the point remains the same. It's you should want to see companies reinvesting as much as they can back into it if the growth is real. Now, I think Nvidia had a buyback, last year, and you can argue that that's what they're doing. But if they're the only ones that are really doing, everybody else is not. It seems like everybody else is skeptical at the top around AI too, even though publicly they make it seem like it's the next best thing.
So we're recording this interview on Monday, February 26, 2024. The 10-year Treasury yield is back up to 4.3%. Do you think that we're in a long-term bond bear market? And what are the ramifications if we are in a long-term bond bear market?
I think it's nuanced. Because the next phase really should be credit spreads. It should be default risk. So I'm bearish on bonds. I'm just bullish on the flight to safety, which is, the flight to quality, as at some point money fears what's happened to how much had gone into junk debt relative to higher quality AAA paper. It's hard to tell because, again, I go back to if AI is what it's supposed to be, then it should be disinflationary. So if you're bullish on AI, you should be bullish on bonds from a very long-term perspective. Because what does technology do? Technology is a way of enhancing efficiency. It's supposed to be a way of lowering inflationary pressure. So what? Now suddenly that doesn't matter. Now, now the idea that technology is disinflationary, it's disinflationary, but it doesn't apply to AI. Like bonds should be strong overall over a multi-year period if that's the case. But, that's another narrative disconnect.
Well, but look at the distortions, though. Look at the agricultural index, DBA. I mean, that's at or near an all-time high. So you have just tremendous, even though energy prices are not necessarily that high with natural gas here in the U.S. low. But I think fertilizer prices, farmers said they haven't paid for fertilizer. Speaking of farmers, a lot of them didn't want to take on the debt. So you have like agriculture prices. So you just have more and more distortions here. There's like disinflationary pressures, or at least the consumer price index is going down, but then the food prices are soaring.
Yeah, and you've probably seen it too, right? I think Wall Street Journal had a piece. I had put it out there also that we've never had food prices as a percentage of income be this high in like 30 years. Now, a lot of that's because of people going out to eat and restaurants, raising the prices to obscene levels. But yeah, listen. None of this, I think everybody can agree. I don't care if you're bullish or bearish. None of this is sustainable. At some point, it's like if you're really bullish, if you really want to be optimistic about the future, you should want to see, a resync, not a great reset, a resync, meaning where things come back into line, where these distortions and divergences come back into line. That would be healthy from a very long-term perspective. But the more and that you have this concentration of wealth, the more that you have this concentration of momentum, the more sick the entire system gets, the more broken incentive systems end up being. So it's like I get accused of being a perma bear, which is funny because you can look at any analysis I've done from October 2022 on, and I was obviously very bullish. But it's like, I am a perma bull. I'm not a perma bear. I'm a perma bull because but to be a perma bull, I'd argue you want to see these disconnects stop. Right? That's the definition of a perma bull should be that you want to see things behaving the proper way and the free market and capitalism taking hold in asset prices. You don't have that.
Yeah, I agree. I think the central banks, the central planners, so the people here in DC, the U.S. Treasury, Federal Reserve Bank, they don't want free markets. They don't want deflation. They want home prices to stay at high levels. So the home builders are subsidizing people to go out and clear inventory and go and buy homes. They're buying back points on people's mortgages. I don't know if they're still doing it at the levels they were a few months ago, but they were doing it at like at least 200 basis points. They were buying on people's mortgages just to get the homes cleared and sold. And it seems like it's almost national security policy. I know Luke Roman has said this. It's almost national security policy that the people in DC Federal Reserve Bank don't want to allow the S&P 500, the stock market indexes, to stay down for very long.
Yeah, I think the reality is people vote based on how they feel about their wealth. People are fooled by nominal, not real, meaning they vote based on nominal prices, nominal wages, not real wages. Um, and I don't think that's a stretch to argue that people in power want to stay in power. Powell's objective is not to be the savior of the system. Powell's objective is to stay in his power seat. And by the way, Powell probably does want to keep the stock market elevated because the guy's worth what, $30-40 million. I'm pretty sure he's got a lot of equities.
I think he's worth more than that. I think he's worth at least 100 million. I mean, he was a senior director at Carlyle Group. He built their bond business. So
yeah.
Carlyle just bought the Baltimore Orioles, so Carlyle's doing really well.
Yeah, I wish I was. Right.
Those private equity guys, they got bailed out, I think, in 2019 and 2020 when Powell was Fed chair.
Funny how that works.
So I know your money management is based off modern portfolio theory and 60/40. Do you think that these passive index flows and policies, are they making it difficult for modern portfolio theory? Do you think they're breaking modern portfolio theory in the 60/40?
I mean, look, I think broadly this environment is horrendous. Okay, let's take a step back. If you're let's talk about from the industry perspective, right? Whether you're a financial advisor or in my case, a fund manager. The problem that financial advisors have in an environment like this is every one of their clients, mom and pop investors in separately managed accounts, they compare their portfolio against the S&P. So they don't care about risk. They don't care about risk tolerance. The end clients will say, you did better or you did worse than the S&P. Okay. This environment is terrible for financial advisors because you can't beat the S&P, have a diversified portfolio, be a fiduciary, if the S&P is the only game in town. It's the only thing that's working. The only thing that's got real momentum. Small caps nowhere, emerging markets nowhere, developed. Other than certain markets like Japan now, right, showing some signs of life. If you are a fund manager, like I am in my case, against the plethora of all these other funds that are out there, the only way to raise assets and to build a fund business is to do something that's different. I mean, in my case, it's risk on, risk off, all in, all out of equities or treasuries. In the case of RORO, ATAX, or in the case of JOJO, junk debt or treasuries. This kind of aggressive rotation, trying to avoid tail events when they appear. Well, I can't, this environment is terrible because in a large cap S&P only world, you get whipsawed. Right? You get a signal that says play defense, the opportunity set's not working, and the S&P keeps going higher. And again, everybody compares you against the S&P. So, in a world where it's only about passive, only about one index, it's horrendous to manage risk through because your clients are not going to allow you to manage risk, right? They're going to just say, chase that performance. Or I'll find a new financial advisor, or I'll find a new fund.
Or just buy an index fund. Or I'm hearing, this is anecdotal, but I'm hearing just the craziest stories from my friends who are asset managers. And then also like people contacting me who I didn't even know like the stock market. I mean, there's people that are trading stock options now on Nvidia, SMCI, ARM. I mean, they're putting a large chunk of their savings in there. One of my friends who's an asset manager, he said one of his 90-year-old clients just called him and said he wants to liquidate his diversified portfolio and he wants to bet a lot of it on Nvidia and ARM and the artificial intelligence stocks. He thinks he can make a very high percentage return in only a couple months. This sounds very similar to prior to the October 1929 crash, like the 6 months leading up to it, where everyone was juiced up on leverage on the tech stocks at the time.
File that under signs of things you see at the top. And I've heard other anecdotal stories like that, with financial advisors. It's again, it can last for a while, right? The timing is always the challenge. The path matters more than the prediction. But I go back to anybody that thinks that this is sustainable and healthy has amnesia, because you don't have to look that far to history to see plenty of examples where you had this type of mentality. For God's sake, 2021, early 2021, 2020 into 2021 with all the crypto coins. It's the same dynamic. And it's not like it was that long ago. And yet the memory is that short. So look, again, I've used this line before, and God bless. If people made a ton of money and became life-changing money, God bless them, right? As long as they can keep it, great. But for the vast majority of people, it is true. You can make a lot of money in manias. Question is, can you keep it? Some people will. A lot of people won't. And, those that didn't participate in it, who are being vilified, will be seen as the prudent ones. But the problem is they're going to lose a lot of assets between now and then until they're proven right.
Yeah, I agree. Stanley Druckenmiller is taking a lot of heat for not staying in Nvidia and some of the other ones. But if you go back and look at his public interviews from a couple of years ago, I think he was in late 2021 or early 2022. He was in these artificial intelligence stocks in Nvidia way ahead of the others. He's now cycle rotation, asset rotation. After buying low and selling high, now he's looking at base metal miners like tech and coal companies, and he's looking at gold miners and oil companies. So he's trying to buy low and sell high. He's repeating it. And this is why over a 30 or 40-year track record, he has such a good track record, because he's trying to stay disciplined in a very difficult environment, as you've described earlier in the interview.
Yeah, and it's like, even that line, Druckenmiller has taken a lot of heat. It's like, why should the guy take heat from anybody? I mean, he's made a killing. He's been more right than wrong with magnitude. Who cares if he's, or going back to the early start of the conversation, it's okay to be wrong as long as when you're right, you kill it when you're right. And by the way, it's a lot easier to kill it when you're right when there are a few other people betting on the pot you're betting on. So I always go back to contrarianism is not about betting against the crowd. Contrarianism is about betting where the expected value is highest. So you have two pots. A lot of people are betting on the first pot. By comparison, a lot smaller number of people are betting on the second pot, and this pot itself is smaller. The expected value, the number of people that you split that payout on is what you should focus on. So you want to focus your bets where there are fewer other people betting, because the payouts can be higher because you're not divided among so many people. It's like there are studies that show, for example, like statistically, right? You're better off playing the lottery under, let's say, 100 million versus when the jackpot's over $1 billion. Why? Because if it's under 100 million, not everybody and their brothers are going to bet on the lottery. If it's over $1 billion, people are and their brothers are betting on it and buying 10 tickets each. So there's a higher likelihood of splitting the payout because just there's so many more entrants. So the point here is, I do think it makes sense to look at all the laggards now, because we probably are late in the game with this AI mania, because everyone's talking about it, because everybody wants to be in it. Because now it's instead of the shoe shine boy that's telling you some hot stock tip, it's literally somebody playing an online game telling some 18-year-old kid that's doing multiplayer or whatever games, or you got to buy Nvidia. It's the same dynamic in a digital form, and that's usually a sign up top.
Yeah, or in this case now, because of all the online stuff, I mean, it's on dating apps. I mean, I've people that they say, "Oh, I just got into the stock market. Oh, I just started stock trading. Oh, I'm trading stock options in Nvidia. No, I made thousands of dollars in my first month of trading." I was like, "What is going on here?"
It's honest to God, it's like no wonder, you look at the stats on like people having sex that keeps on dropping, and it's like this whole environment is bonkers. Really is bonkers the way that people are thinking about things.
Okay, so for sectors or industries that are cheap and hated on valuation, you mentioned utility companies. So utility companies, gold miners, are those the types of industries that you're looking at now, risk reward for companies that are profitable, free cash flow, dividend yields? Are those the industries you're looking at right now?
Yeah, I think so. So look, I mean, utilities have gotten destroyed on a relative basis, in the first 2 months here. And at the start of the year, I said I think utilities will be the best performing sector by the end of the year. And there's plenty of time for that to still be the case. And I still maintain that. When you look at the differential between the tech sector and utilities being the most defensive bond-like proxy for the market, you're now reaching the tech blow-off ratio levels of the year 2000, before the NASDAQ peaked. So when you have sector performance being that differentiated, that's the contrarian part, right? That's the payout's going to be higher betting on utilities, I argue, than tech at this point. And I think it makes sense. Again, aside from the fact that utilities should be clear winners if electricity is going to be as needed for these AI dynamics as it seems, it's like what? I mean, nobody cares about a high dividend equity sector that can do well in a bear market like it did in 2022 2. It's like, people are just totally abandoned it. So I think that makes a lot of sense because nobody's really focusing on it, which is not a very popular opinion, which is probably why it works. And then I do think on the base metal side, I think on the gold side in general, makes a lot of sense. There's an interesting short-term dynamic here where if the dollar were to really push to new highs, they're basically, if you look at like an ETF, like the UUP dollar ETF, you're pretty much back to October 22 levels. If the dollar were to suddenly move big time and have a scare, there's going to be, I think, a flight to safety into gold. Because I don't think, you want to, I think the argument for gold and gold mining stocks is very simple, right? It's the reemergence of counterparty risk. And counterparty risk certainly goes up when you have a currency crisis by foreign holders of dollar-denominated debt. And I actually think that's a good chance that could happen. And that, arguably could be the credit events, dynamic right there. So in the same way that everyone is hyped about tech, people are hyped about Bitcoin. In the same way that I'm hyped about utilities because of tech, I'm hyped about gold because of Bitcoin.
There's a big divergence right now between the gold price, demand for physical gold from non-G7 central banks, private sector in China, India, Turkey, emerging markets, where there's a faster currency debasement than the dollar is being debased, and then the gold stocks. So the gold stocks, some of these gold companies have very good profits, and yet the valuations on some of them, they don't reflect the gold price at all. I mean, some of them are pricing in gold prices below 1,500, and yet demand for the actual gold is soaring. So I've interviewed people like Rickroll and others in the industry. They haven't seen this type of disconnect. I think they said once or twice in 40 years.
Yeah, and honestly, I think this is one of those things where you need to have the tech momentum break to get people, to get money to care about these valuations. Nobody cares about valuations when you're in a FOMO trade, right? It's like if it ain't broke, don't fix it. So why should I reallocate these cheap assets when I'm getting all that momentum in these AI stocks?
Well, you also have, what is it, over 6 trillion that's also in money market funds and the short-term treasuries. People are getting paid over 4.5% just to park cash there. So you have a divergence there. You have a lot of short-term cash parked in those that is going away from the utilities that you're talking about, because those businesses sound like they're fine. There's no problems with them. There's a lot of oil and natural gas producers in the US and Canada that have good free cash flow yield, good dividends too. And the valuations are just super cheap. So they're kind of in the same bucket as the utilities right now, because the average investor wants yield. They could just go into money market or short-term treasuries.
Yeah, I think that's right. I think the demand for utilities as a sector is more just sector reallocation, right? Because it's not, because you're right. It's like, why would you buy utilities for their dividend when you can just get T-bills at a roughly same yield while then having the beta risk? It's largely, it's going to be at the margin money that's reallocating from, an overextended tech sector allocation to underinvested, bond-like lowest beta with dividend sector, right? It's I think more of that. But I think you're right. I mean, it's everything is competing against, a 4.5% yield.
And then also the risk on part of people's portfolios tends to just go into S&P 500 index, and then in artificial intelligence like Nvidia, only a small percentage. So you have kind of people playing kind of a bifurcated investment strategy where they have some cash parked in short-term treasuries or money markets, and then their risk strategy is solely S&P and artificial intelligence. And that seems about it. I mean, that's not diversification, but that seems to be the way things have played out for the last 6 to 8 months.
Yeah, and it's I've said this to other financial advisors that I talk to, but I mean, it's like you're almost at the point where you have to give up being a fiduciary in order to participate. Because I go back to, it's not a diversified index anymore. It's not the market. People say the market's the S&P. I mean, is it really the market when it's just a select number of stocks when you have this type of concentration? It's not a reflection of the market. It's a reflection of a select number of stocks that are driving it.
Well, you're a fund manager and you have to deal with compliance people. I just saw someone on business television, and this portfolio manager said that they have 70% of their technology investment fund into Nvidia, ARM, SMCI. So it's like 3 stocks, 70% of their portfolio. That's pretty nuts. Is that even allowed?
I mean, I have to see the prospectus. I mean, it certainly could be allowed. It wouldn't be a diversified fund, I think, by definition. But this is the kind of stuff you see, right? And there are plenty of examples of parallels like this in the 90s, late 90s. where these funds really took it to the extreme. They were killing it, getting assets, and then they gave it all back, and then went broke. History does rhyme, right? It's not a bubble in the traditional sense of what we saw in the late '90s, but there sure are a lot of similar behaviors taking place.
So you see, by not a bubble, you mean that it's not as widespread. So the market breadth. So we're not talking like back then the tech bubble. You're saying all those different internet stocks. Anyone who's advertising, oh, we're getting clicks or eyeballs.
Right.
Those shares were going up. So it's more concentrated. That it's only like a handful of artificial intelligence companies or chip makers.
Yeah, and back then there were plenty of companies that were just going through the roof without any real fundamentals. I mean, obviously Nvidia has got tremendous growth. Right, nobody's disputing the growth. What I'm disputing is the narrative disconnect against the price. It's like if earnings are going through the roof, but then the price is going to the moon, then the price is not going to the moon because of earnings.
Well, didn't the stock market index add about $1 trillion of market cap, and Nvidia's earnings were nowhere near that? So I mean, the market's getting frothy here with the valuation multiple add-on.
Right, and that's actually exactly the point. It's like none of this stuff is commensurate with the beats at all. I mean, what? So how much on that point about how much market cap it was increased following Nvidia? It's like, so now you're telling me that Nvidia earnings causing that type of a wealth effect, that's more powerful than the Fed. That actually creates inflation. Like, this is stupid. Doesn't make sense.
Well, at some point, the interest rates where they are, and you've talked about this with small caps. I mean, we're seeing it on the consumer with auto loans, credit card debt. The consumer doesn't have the discretionary income they did because they're spending a lot of their bills on groceries, food, utilities, these cost increases, rent, mortgage. So the consumer just doesn't have, most consumers don't have the discretionary income. I mean, I think the lag effects are going to start to play a part at some point soon. I don't know exactly when on the timing, but it's coming.
Yeah, and the lagged effects typically hit when everybody thinks there's no more lag, or when that we're past the window. Right? I mean, that's always how this works. When people forget that there are lagged effects is when the lagged effect hits.
Exactly.
So I'm still very focused on myself, and I get all this vitriol. And again, it's not like I'm short. My funds are designed to be long only, right? And they've been actually risk on in a good amount of this year, right? But I'm trying to stress that there's going to be a moment where the risk is highly, highly elevated. I think March could be high risk. I could be wrong. I don't know how high risk. It's not clear to me because manias can get even more manic, right? But this is always what happens. Market. The whole point is that you have to people have to be surprised. In order for people to be surprised, they have to forget.
The other part of the lag effects, doesn't it take on average about 22 months for an inverted yield curve? So people are like, oh, the inverted yield curve, oh, it didn't do anything this time. I think on average for a recession or a stock market crash, it takes in the past about 22 months for it to get priced in.
Yeah, and again, everyone forgot about that. Everyone has become so short term, and it's like a national. It's just like attention deficit disorder on everybody. I mean, it really is that. So, it'll be obvious after it happens, right? But in the meantime, everyone's being distracted by here's the birdie. Look at what this AI can do with it. Look at how many images you can shitpost with now. With some celebrity that you're using AI to create some kind of nasty image with. I mean, this is what's happening to the environment. I go back to you. Anybody really think that's healthy?
Oh no, it's definitely making a worse wealth disparity, and also for the companies. I mean, these small, because of the passive investing index fund bubble, a lot of these small cap companies are not getting the capital they need to make the investments to grow. So I mean, this is going to hurt because it's the small companies, the entrepreneurs, small businesses, the small caps that create the jobs long term. They have to make the investments.
Yeah, and that's why it drives me crazy. People are saying, "Oh, everyone's indexed. Nobody cares about small caps." It's like, okay, see what happens to unemployment if you take out a quarter of the Russell 2000 if they go bankrupt.
Yeah, the average person's not thinking about the small caps are the ones that eventually make the investments and that create the jobs. Look at the headlines. Right. All the firings they're not government employees that are getting fired. It's all financial companies, banks, and big tech.
Right, and that's why I keep saying small caps hold the key. That's why this is such a weird environment. I've gotten a lot of things wrong and I never thought it would play out like this. But you can't deny the price action of And by the way, I'd argue because going back to the indexation point, that's why small caps are a better indicator of what's actually happening because they don't have that auto bid that market cap, Vanguard, large cap flow, right? I'd argue there's far more better price discovery. You really want to get a sense of the future. You look to small caps, not to large caps.
Oh, the small caps have been in a bear market for over 12 months. I mean, there was a brief rally and some of them did some refinancing, but in general, it's the cost of capital. It's not really available for a lot of them. And some of the ones that can't do capital raises, they're doing joint ventures to survive or they're selling the company.
Yeah, and listen, I mean, again, I think small caps, there is a case to be made to be contrarian there. But the more that the problem is that every day that goes by that small caps don't show some real momentum, you get closer to more and more of that debt needing to be refinanced. This is the fundamental problem. So as every day that goes by, you're closer to the debt tsunami needing to roll over. Again, they might survive and be fine, but you're kind of at a juncture now where if it's going to be higher for longer, the Fed can't really step in right now to save small caps because there are delays in them lowering rates too to save small caps. So slowly, then all of a sudden, suddenly all these concerns matter. But again, I go back to that has to be the reason why small caps have not done well. There is that headwind.
Yeah, there's a fear of missing out with whatever you said in the price action, whatever is doing well. So people are just chasing whatever's already going up. So it's buy high, sell higher is the narrative, fear of missing out right now.
Yeah, and the reality is FOMO is more powerful than the Fed. I mean, fear of missing out is more powerful than interest rates. It's very clear.
Well, interest rates take some time. So you had the situation where a lot of corporations refinanced in 2020, 2021 when rates were cheaper. So it didn't take effect right away. So if you were a company and you did all your refinancing close to zero or below 3% or lower, you're okay for a while until you have to refinance again at higher rates.
Yeah, correct, right. And it goes back to this. It's always a timing mismatch between people's expectations and when things actually impact them. Right. That's I think at the core that's the best way to kind of sum up everything. It's always about the timing mismatch and the perception around it.
So last question, based on what you're hearing from the Fed and the way the market is acting, do you think the Fed has to see something break first big, like this credit event, regional banks, commercial real estate, some type of big failure or crash before they decide to cut rates? Do you think they're going to wait a long time?
I don't know if it's a long time, but I fail to understand how they can lower rates when credit spreads are this tight, right? So when credit spreads are very tight, that's reflationary. When credit spreads widen, that's disinflationary or even deflationary. So if they're going to lower rates with credit spreads and default risk being this low, they're going to spark another wave of inflation. So they need to see default risk rise. They need to see credit spreads rise before they can lower, because that's why they lower. They lower to shrink that differential between junk and high quality. So now I would argue that the Fed wants a credit event, or at least they want to see widening credit spreads, not to the point where it's like carnage, right? But they want to see some of it, because that's, it's like if going back to the last mile problem, right? It's like if the last mile is they can't get us from down to 2% inflation with interest rates alone, an event would do it.
Well, I thought they had done it in February of last year, about a year ago with Silicon Valley Bank, but then there was a panic from what I hear, and they created the BTFP, and then the banks then started borrowing other liquidity from like FHLB. They got up to over $1 trillion borrowing from FHLB. So there are other liquidity sources that a lot of people aren't aware of. The bankers know what to tap in the BTFP, but maybe if the BTFP for a couple months isn't extended, maybe there's going to be problems.
Yeah, we're gonna find out soon, right? Because that pretty much is over. I think mid-March, right? I think is the date. So a lot of things will be resolved, I think, fairly soon in terms of what happens next.
So the way, from what I understand right now with the BTFP, that anything that was borrowed is allowed to be extended for another year, but no more additional borrowing.
Right.
But I don't know, the market could figure out that there's all these problems with the regional banks and they're not going to get any more credit. And the regional banks could start to crater pretty soon after the BTFP is no more additional borrowing. So, but unfortunately, we're in a fiat currency and credit system, and it's really easy for the Fed to keep rates at these levels and then just create another shadow liquidity program on the side.
Yeah, I mean, the Fed will always be creative at preventing creative destruction, which is where everything goes wrong.
Well, you've been in this business longer than I have. I mean, post 2008, it just seems like things just changed. I mean, they created what, an alphabet soup of programs in 2008, 2009, and they created another alphabet soup of programs during the pandemic. So they just panic anytime things start to crash or the dollar starts to have a big rally, things that could collapse the system. They start to panic and roll out all these weird liquidity programs. And yeah, all of them might not be tapped at enormous levels, but the market starts to get reassured. Okay, there's enough liquidity there. Okay, there's enough credit there. Okay, rates are going to come down, and then the market starts to rally.
And the cycle repeats, and that's always how it is.
And this is why I'm a fan of Austrian School of Economics, because the government and the central banks are creating artificial boom and bust cycles and tons of asset bubbles.
Yeah, exactly. And they only get bigger and bigger by amplitude and by depth. I mean, that's just the reality too when you have so much leverage in the system.
Well, I really enjoyed our discussion today, Michael. I think we're going to have a lot more asset price volatility going forward coming in the next couple months, because if BTFP, the market's going to start to worry about these regional banks, there's definitely problems there with commercial real estate. Commercial real estate problems are not going away. In fact, I think it's spreading. It looks like it's hitting the pension funds in the European Union, Asia. I mean, there's a lot of pension funds outside the United States that are invested in U.S. commercial real estate. There's commercial real estate issues in Europe too. It's just a mess.
Yeah, yeah. Again, there are still problems out there, and they may not matter now, but when they matter, it'll be the only thing that matters. And everyone will say they saw it coming, and few will be positioned for it.
From speaking with a banker off the record, the banker said it's almost exactly like 2005, 2006, and 2007 all over again, except this cycle, it's not residential real estate. This cycle is going to be commercial real estate.
Yeah, could be. No disagreements. Well, listen, I guess the point is we're going to find out soon enough, just because you're at that point where the lag should start to hit.
Well, especially with government borrowing now, because interest payments on the debt are one of the two highest line items.
Right. Yeah, exactly.
So if my listeners want to check out Lead Lag Report or listen to some of your interviews, how do they do so?
Yeah, appreciate it. So, I mean, Substack is the primary way now that I focus on leadlagreport.substack.com, across X, Threads, YouTube, at Lead Lag Report. And then the podcast, which I want to have you back on as well, Lead Lag Live on Apple, YouTube, and Spotify.